All right, welcome everybody. Nitsan Moser here, the Traveling Investor, and welcome to another week of the Traveling Investor Group Strategy Calls. And this is where you guys get to ask questions and we get to discuss everything under the sun, being it where it involves your mind, body, and wallet, goal setting, mindset, how to set up your business, how to set up your companies, how to create your team, raising capital, finding deals, evaluating different cities. Whatever it is, this is the time for you to ask questions. All right. Now, I do have some questions that people have sent me throughout the week, but I always like to start it off with people who are actually live on the call. So if anybody wants to start off, you can type your question down below. You can raise your hand and I'll unmute you. And if not, then we'll just go right into the questions. The questions that people have emailed me. And then, I'm going to share something with you. Well, why don't I do this now? So before we get into that, I'm offering anybody that's listening to this right now, I'm offering a referral program where you refer someone to come to the group coaching calls. You get 1 month free for every person you refer who wants to learn about multifamily, real estate, life, all that good jazz. So for every person that signs up, you get 1 month free. I'm also starting my 6-week master class May 3rd. Okay, May 3rd, and it's going to be in the evenings. I believe I set it for 8:30 in the evening. And this is where we're going to be learning step by step on how to acquire, find, deal with brokers and agents, how to raise capital, how to manage, all that from A to Z. And we'll also talk about how to set goals, negative limiting beliefs, and how to replace them with positive expanding beliefs, right? All that stuff. So that's May 3rd as well. And also, every Thursday at 3 p.m. Eastern is the Traveling Investor live show. It's a live talk show where I interview people that help us master our mind, body, and wallets, right? So yesterday I had a guy who's the COO of a new platform that is going to come out with a new coin, crypto coin, that is backed based on silver and gold. So we talked about cryptocurrency. So that's Thursday at 3 p.m. Eastern. All right. So if nobody has a question from the audience, I'm going to get into the questions that were emailed to me. Nope, we got one question. So let's see what we got here. A second. What deal structure seems to be most appealing for investors? What percentage rate captures their attention? Are there different levels they can come in under? All right, let's take this one step at a time. What deal structure seems to be most appealing for investors? The deal structure is probably where you're showing conservative numbers, first of all. And if I'm understanding you correctly, the structure would be, I would say, around a 70-30%. That's kind of where we structure it, where we start off and we see where that goes, right? And so 70% goes to the investors and 30% goes to the general partnership that is asset managing the property and making sure everything's going smoothly. Um, Now, what we like to offer our investors is a 7% minimum, meaning that what we're trying to accomplish is that they will get no less than 7% return on investment every year. Okay, so that's 70% of the cash flow that we give them should equate to a 7%. Now, if that doesn't equate to a 7%, then we give them from our share, the GP, until they until it hits that 7%. Now, the total return, they obviously, the higher the better, right? But we don't want to be too aggressive. But what we've noticed is that now between 15 to 20% per year on a 3 to 5 year hold, usually ending in year 5. Um, that's where we're at. Now, obviously, I have to say, every deal is different. Every property is different, so we have to take everything, step by step and within its own numbers, right? So you got to look at that. But again, it depends where your investors are coming from. It depends on what they're used to, what they see out there in the market. You do want to be somewhat competitive, but you want to make sure that the numbers that you're creating, the numbers that you're projecting, are conservative and that you can hit them. Okay, you don't want to overpromise and underdeliver, right? You always want to underdeliver, over deliver and underpromise, right? So, so I hope I've answered that. Are there different levels they can come in under? I'm not sure I understand. Are there different levels that they can come in under? You can come in as a general partner, right, and be part of the team, or you could be a limited partner where you invest your funds and you have um, you're kind of a passive investor. Okay. There are, right. So there's Class A shares, which are the limited partners. Okay. And they have a limited say. They're more passive in their investments. And then you have the Class B shares, which uh, take up the 30%. Now, the Class B shares don't necessarily have to be the managing members, right? The Class B are the general partners, and then you have your managing members, the people who are managing the LLC and so forth. So I hope that answers your question. A great one. All right. Anybody else have a question? You want to? Do you have a follow up, Cliff? If you do, just type it in there, and we'll get to it. All right. So in the meantime, what's the difference? I get these are questions that were sent. What's the difference between seller financing and lease option? Okay, that's a great question. Um, the difference is, let's start with seller financing. Seller financing is where you become, let's say you're the buyer, okay, in a seller finance situation. So you're going to the seller and you're saying, listen, I want you to act as the bank. So let's say they're selling a house for $100,000 and you say, I want you to finance me just like a bank would, okay, $80,000. I'll give you $20,000 now, and then we'll create a mortgage, we'll create a note, the deed will be transferred over to me, the new buyer, right, the new owner. However, I will owe you $80,000 and I will pay you an interest rate, an annual interest rate, and I will pay you either interest only or principal and interest. Now, as a seller financing, remember the seller now is deeding the property over to me and they're making as if they're the bank now, right? They didn't actually give me the $80,000. They just kind of lent it to me on paper, right? So I gave them $20,000 and then for 5, 10, 20, 30 years, however you decide to with the seller to create that note, that's how long you go for, right? So in a seller financing, the deed, the actual ownership of the property transfers from the seller to the buyer, where the buyer now becomes the actual owner of the property. Now, if the new owner, the buyer, doesn't pay the mortgage, right, what happens? You get foreclosed on. So if you don't pay the mortgage, then your lender, who was the owner of the property, they can foreclose on you, right? And go through the whole foreclosure process. Versus a lease option. So in a lease option, you're renting the house and you're claiming all of the expenses as well as if you owned it. Okay. So now you're leasing the property under a triple net lease, right? You pay taxes, insurance, and all the other expenses, right? Utilities and so forth. But you're a renter, you're a tenant. Okay. and you're paying rent to the owner of the property. Now you have another agreement, a purchase and sale agreement that is separate to the lease, where you've both agreed on a future date where you're going to purchase the property, a future purchase price, and the terms of the agreement. So you have now two agreements. One is the lease agreement that you're going to lease for 1, 2, 3 years, right? And then you have the purchase agreement that says in year 4, you're going to buy the house at this price with these terms. Okay. Now, if you decide not to pay your rent here, which is rent, it's not a mortgage payment, then the owner, who's still the owner, the deed has not transferred in a lease option because you're only renting the property from them. You're renting it with the option to buy it later on in the future at some predetermined time and on predetermined purchase price and terms. So the deed hasn't transferred hands. So now if you don't pay, then the owner can evict you. Now, under a lease option, you're probably going to have to put down some sort of option payment, non-refundable option payment. That means it's like a down payment that you're giving the owner. Now, if you're the renter and you're giving an option payment, what I recommend is that you tell the owner, you say, for every option payment that I'm paying you, for every dollar that I'm paying you, is that goes towards as the earnest money deposit when we, or the down payment when we purchase the house, right? So let's say every year you have to come up with another $2,500 of option payment, and you've, the first year was $5,000. Then every year after that is another 2,500, and you've done it for 2 more years. So that's almost like a $10,000 option payment that you've paid the seller, which is non-refundable. You want to make sure that that goes towards the earnest money deposit or the down payment of the purchase agreement. Okay. You want to make sure of that. And here also, all of the utilities, insurance, real estate taxes, expenses of the property are put on the shoulders of the tenant. Okay. The seller now has no responsibility over the house. So that's the difference between seller financing and lease option, right? All right, great question. Let's see here. Cliff continues. The other option is a lower pref with an opportunity to be paid additional after disposition. Yes, absolutely. Right. You can always say we're going to give you a 9%, 9 to 10 with no later payment. Lower pref of 6 to 7% with additional compensation that may average 16 to 20. Yes, absolutely. Right. But what I've learned also with my investors that I'm now working with, for example, and again, it's all how you want to structure it. It's your deal. You can structure it any way you want. You just want to make sure that your investors are okay with it, right? So our investors, they don't personally like that section where we're telling them we'll give you a 6 to 7% with additional compensation. They want to know they want to know, look, year one, are you going to give me a 6 or 7%? No, tell me what you're going to give me. Okay, so year one, we'll give you a 5%. Okay, great. Year two, what are you going to give me? So it's all depends on the investors and what they like and how they want to be presented, right? We know that, yes, you can give a lower preferred return of 6 to 7%. And then when you sell the property and you give that additional profit to the investors, that'll bump up their average and their total return. So yeah, you can definitely do that. Right. Or you can also say, we'll give you all of the cash flow or a majority of the cash flow throughout the hold period. We'll give you a higher preferred return, but when we sell, instead of it being a 70-30 split, we're going to do a 50-50 split on the profits because we're giving you most, if not all of the cash flow, and we're not collecting anything as the general partnership. So yeah, that's definitely, you can do it that way as well. Absolutely. All right, great questions. Great questions. All right, here's another question. What is RUBS? Okay, RUBS. RUBS, if I'm not mistaken, stands for Resident Utility Billing Systems or something of that nature, right? Basically, what it is there are companies out there. Okay, RUBS meaning is the property a RUBS property or all bills paid? So all bills paid, as it sounds, is where the owner of the property pays all the bills, right? So you can average and say, well, a one bedroom will take $50 worth of electricity and $30 of water. Okay, so that's $80. Their rent is $500. So you can say, okay, 580 or $600 a month is the rent for this property, all utilities included. That's an all bills paid. Where a RUBS is where you can break all that down, or you hire a company, okay, and they will then divvy up the utilities based on unit size and usage and all that stuff, and then they will bill the tenant for their utilities. So they're billing back the resident, right? Um, you also, if the property is submetered, then the tenants pay their utilities on their own, right? But a RUBS system is where you bill back the utilities to the tenants so you can capture that some of that income, right? Because you're paying for the utilities for the whole property. Let's say you're paying $100,000. Some states you can, each state has a different level of how much you can bill back the utilities to the tenant. Okay. Some is only 50%, some are 80%. Some they say you can build back all of the utilities. Some say you can build back some plus more, I think. So it depends. And you have to find out what your city, state, what the laws are and the legalities of that is. But it's basically having the utilities build back to the residents so that you can capture some of that income and not have that much loss when you're paying the utilities. All right, we have a follow-up question here from Cliff. What does your preferred rate compete against? Example, is it against the S&P 500 or something else? It competes against other syndicators for us, right? That's what we're doing. Plus, we're not really looking to compete with anybody. All right. I'm looking to give a solid investment to our investors, right? I want to give them something where we're underwriting it conservatively. It's backed by real estate, by brick and mortar. It's backed by a strong, or an economy in the city that we're investing in, that is booming, that is thriving, that is moving forward. That's what we're kind of going up against, right? So, if the S&P is doing one thing, if the stock market, right, or cryptos, whatever it is, um, I'm going to look to the property and see what numbers we can realistically create for that property. Okay. And, listen, you got people today making a crap load of money on cryptocurrencies, on the stock market, right? Um, But once they make that money, guess where they're putting it? They're putting it into real estate because they know that real estate is going to appreciate over time. So a lot of times they don't mind parking that money in real estate, knowing that it's going to appreciate, even if there's a downturn, as we've seen, right? We came out of 08, 09, and look what's going on now, right? Here in Florida, things are ridiculous. People are buying houses sight unseen, and it's not going to end anytime soon, right? Baby boomers, right? The old folks, then their kids, and more families are coming down. So, you know, it's not necessarily what are you competing against, right? It's how can I create an investment opportunity for my people where the risk has been minimized, right? It doesn't disappear, but where we can minimize it, right? Hope that answers your question. All right, let's see what else we got here. Should we add a swimming pool to the property if all the comps have the same amenities? That's a good question. So they're asking, right? If you're buying a property and all the other properties around you have a swimming pool, should you build a swimming pool? That's a great question. You would really have to investigate the other properties and see, do people use the pool, right? Is it an amenity that is being used in that area? Does the demographic of people use public pools? Who knows, right? Every neighborhood has its different ways of doing it, right? Maybe there's who knows? So you want to investigate that. You want to investigate that neighborhood, the area, the different properties, um, and ask the property manager, hey, do people use the pool? Is it a big source uh, of traffic for you guys, right? Does it draw a lot of people because you have a pool? Well, not really. We have the pool. The pool was built with the property, but lately, past last couple of years, no one's been really using the pools. Okay, so that may be a trend. But then again, right? If you have space, and then it's a place maybe like in Florida, something where all the other places have pools, and you don't have a pool, and you can really add value to it, where if you're building a pool, right, that's what, 60 $100,000 maybe, right? I don't know, I've never built a pool, but I'm thinking about that price. What's going to be your return on investment? Are you going to be able to raise the rents that drastically and that dramatically? Are people going to want to come to your place now even more because you have a pool? So these are some of the questions you got to ask, and you got to come up with those answers. I can't really answer it for you, right? Um, Usually putting in a pool doesn't really make that much of a difference, right? Because once those properties that have the pool are occupied, people don't have anywhere else to go. So they're going to go to you if you have a nice product, right? Okay. Should I buy a vacant property? Oh, well, you know, you can buy a vacant property as long as you know what you're getting into, as long as your investors know what you're getting into, right? You got to make sure that you have enough working capital, enough mortgage interest reserves, taxes reserves, insurance reserves, and your CapEx money, so that you can really go in there and start renovating and then leasing up. But I would make sure that you are in a place where there's going to be a lot of traffic and it's going to be easy for you to lease up. And I would do a lot of homework, meaning I would walk the neighborhood and talk to people about that property and see what they have to say. How long has it been vacant? Do you know who owned it before? What was going on there? Right? Why did it shut down? Because you want to know, right? You don't want to buy the property that was the meth house of the area, and now it's going to go back to being that again, and the feds, they closed it down and blah blah blah, right? So you don't want it to be that property, so you have to investigate. Let's see. What's the difference between NOI, net operating income, and net income? Okay, so net operating income is the income that you have after you've taken the gross potential income, right? All the units at 100%. What would that gross potential income be? Minus your vacancy, your concessions, bad debt, all that jazz, right? And then you get your gross income. Then you take your gross income and you minus all of the expenses, right? Working expenses. Um, Real estate taxes, insurance, management, repairs and maintenance, vendors, licensing, accounting, property management, if I didn't say that already, um, utilities, right? All that stuff, that all the expenses that you incur while running the property. That, right? You subtract that from the gross potential income, and that is your NOI, your net operating income. Okay, that's why it's called net operating income. This is the money that you still use to operate. Now, what are you taking now? Net income is, you take the net operating income, you subtract your mortgage and your interest, okay, and that is your net income. Now, that's before taxes, obviously, right? That's net income of the property after all of the expenses. You've taken the working capital, the working expenses, you got your NOI. Then from there, you also subtract your mortgage expense, your mortgage payment, and your interest, principal and interest. And then you have your net income, right? And obviously there's taxes that investors have to pay and you have to pay and so forth, but that's the net income of the property. That's the difference between NOI and NI. NOI is gross potential income minus all the vacancies and all that, minus your working expenses, and you get your net operating income. The net income is you take your net operating income, you subtract your mortgage and your interest, your principal and interest, and then you get your net income. Okay. Excellent questions. Anybody else from the audience want to ask a question? Let's see here. What is the difference between an accredited investor and a sophisticated investor, and how do I know who's who? Okay, great question. So, accredited investor versus sophisticated investor. An accredited investor is someone who has who qualifies based on the Securities and Exchange Commission qualifications of what is an accredited investor, right? That's someone who has a net worth of over $1 million, $1 million or more, excluding their primary residence. I think they have to make $250,000 by themselves or $300,000 combined with their spouse, right? So there's certain financial criteria and financial requirements for you to hit to be a accredited investor. A sophisticated investor is someone who is sophisticated, who understands investing, who maybe has dabbled in the stock market and the cryptocurrency world, mutual funds, right? Has bought some real estate, owns, a duplex or whatnot, and has an understanding, a strong understanding of what it is to invest, right? To invest. So that's kind of the difference between accredited and sophisticated investors. Now, how do you know which one is which? Well, what we like to do is once we get to know, and we build relationships with investors, there's a form. It's an accredited investor form. We call it investor qualification form, right? And we say, listen, we want to be, compliant with the SEC. We never share your information, but we need for you to fill out this qualification form so that we know that you're a qualified investor. Okay. And they fill out the form. And in the form, it gives the definition of what a sophisticated investor is. It gives a definition and qualifications of what an accredited investor is. And they have to check it, right? Now it's up to us, the sponsors and the GPs, to go and to make sure that what they said is true and to investigate. So we could ask for tax returns from their CPAs. We could ask for bank statements, things of that nature, right? And that's twofold. That's to protect us from you and to protect you from us. Meaning that I cannot meet you today. Let's say I have a property under contract and I'm raising capital, and I meet you today and you're a sophisticated investor and we just met and I'm raising capital already for a deal. I cannot pitch you that deal. You and I have to have a pre-existing relationship. Now, the SEC doesn't really define what a pre-existing relationship is, right? But you have to show that, yes, this is not the first time that we've spoken. Blah, blah, blah. There has been a relationship building here and there, and now I can present this to you. And the reason why is because you want to get to know your investor, especially if they're not accredited. So if they're sophisticated, you want to get to know them so that you know that they understand that this is a risk and that there's a possibility that they would lose their money. Plus, you want to know that this is not their last 10, 20, 50, $100,000. And if they lose this, they will be devastated, right? So that's to protect everybody. Now, in some of the offerings where you can bring in sophisticated investors, you obviously have to have a pre-existing relationship. It's good for them to fill out that form so that if the SEC ever comes up, you can show them, yes, here's the form. I filled it out and it's all good. And in any one deal, you're allowed up to 35 sophisticated investors and an unlimited amount of accredited investors. Okay. So that's the difference between accredited and sophisticated. And that's how you find out as well who's who, by them filling out the investor qualification form, right? And the way I pitch it also sometimes is I do it this way. I say, listen, we don't like to bring everybody into our deals. We like to qualify our investors because this is going to be our marriage and we want to make sure that we are a good fit. So would you mind please filling this out for us? right? So you get that both ways. All right, guys. I want to thank you for being here. Great questions all around. Next week, please come with your questions. This works well when there's a interaction, a back and forth. And remember the referral program for every person that you come in that signs up for the group coaching, you'll get 1 month free. Masterclass starting May 3rd, 8:30 p.m. Eastern, and every Thursday at 3 p.m. Eastern, Traveling Investor live show where we talk about how to master your mind, body, and wallet. Until next time, I'm Nitzan Mosery, the Traveling Investor. I will see you somewhere on Spaceship Earth. Be well.